This question has more to do with your purpose rather than your age, because as you get closer to retirement, I could make the point that you should be more invested into stocks rather than bonds. And that's because as you start to withdraw cash from your nest egg, so magical, the more you should be invested in stocks. Now there's a lot more where that came from. Talking about the information, not the actual eggs, but there's a lot more where that came from too. So guys, if you are excited to learn about stocks, bonds, and dividends and all their differences, and I already know what you're gonna say. Best day ever. I've always wanted to learn this stuff. Let's just begin. Did you know that bonds were the second largest and second oldest asset class in the entire world? Yeah, second only to gold. And did you also know that the bond market has far more money in it than the entirety of the stock market? Yeah, I didn't know that either. Trillions of dollars more, in fact. But you know what they say? One man's junk bonds are another woman's dividends. I'm sorry. I'm really proud of that one. Nobody says that. I made that up. I'm really excited because I've always wanted to know exactly what bonds are and how they affected me and how they compare to stocks and whether or not I should be investing in bonds myself. Now, usually early in the video, I try to find a reason to flash my dividend portfolio at you so as to establish my credibility and manhood. So naturally, this is my Robinhood dividend growth portfolio right here, worth roughly $200,000 and paying me almost $600 every single month passively to just sleep and do nothing. Yes, I am very insecure, so please smash the like button and help me grow my self-esteem faster than the growth of Tesla stock. Yes! Woo! Wait, I don't have any Tesla stock. Perhaps you've heard that bonds were a great way to secure some very safe fixed income. And conventional wisdom does say that as you get older, you should shift your investments from stocks all the way into bonds to smooth out the ride in retirement. And while every portfolio could use a little bit of bonds, I am here to challenge this idea. So let's get down to the basics and I'll explain exactly what a bond is and how they work. So a bond is a debt security, not unlike an IOU. When you buy a bond, the issuer promises you a fixed percent interest rate throughout the duration of this bond. This is called the coupon or the coupon, however you like to pronounce it. Not sure why it's called that, but it's called that. It's called a coupon. So there it is. And they also promise to give you back your initial investment paid back in full 100%. So you get to make back your money in addition to whatever interest you've received throughout this bond. This is called par or face value, and that happens at the end of the contract or when the bond matures. So that can take anywhere from a few years to even a few decades in the future. I hope that made sense. That was as basic as I could explain what a bond exactly is. Now, bonds are extremely powerful because unlike stocks, they promise you a virtually guaranteed rate of return on your money despite what the stock market is doing, whether it's going up or down or sideways, or whether you got this bond from a company that's not making money. As long as it's solvent and it has money to pay, the bondholders get paid out first at the end of this contract date, which is, remember, the maturity date. And while this is all great and all, makes us feel very comfortable and all good inside, you can actually still lose money investing in bonds, which is a weird thing to say because I just spent a minute explaining why it's virtually guaranteed. But here's how you can lose money investing in bonds. Let's pretend you bought a 30-year bond that's yielding you 4%. You're thinking, yes, this is amazing, 4% is great, and it normally really is. But for whatever reason, after holding it for a few years, you realize you can get way better returns from parking your money in something like Robinhood's new checking account, which I haven't tried yet, but I'm sure it's gonna be awesome because the government, for whatever reason, increased the interest rate to a baseline of 10% now. How then do you get rid of your bond that's only yielding 4% when the other investors know they can just get a new bond from somewhere else that's going to yield them 10%? Well, you have to drop the price of your bond to meet market demands, because by dropping the price of your bond, your yield increases. The yield is, remember, the interest rate. So the interest rate is inversely correlated with the price. So as the price is lower, the interest is higher, and vice versa. As the price is higher, the interest is lower. But by doing that, guess what? By prematurely selling that bond, you just lost money. And that's also because bond prices can fluctuate depending on a few factors like their credit rating, inflation rate, which is a big one, and of course the interest rate, which is what we just talked about. Now, if the opposite happens and the government lowers the interest rate below that 4%, then you can sell that bond at a premium and make some money on it. But all of this is only a concern if you sell your bond ahead of the maturity date or before the contract expires. But if you can wait, and I know sometimes that can take years, if not decades of time, but if you can wait, you'll get back 100% of your money plus all the other interest that you've earned over time. Now, are bonds any good then? That's the next question. Should we invest in them? Well, bonds were an incredible investment opportunity in 1981 when the long-term bond yields were as high as 15%. Now, in contrast, my dividend stock portfolio, which again is not a bond, so that means much more risk than a bond, is yielding only 4%, not 15%. Of course, that's not counting for the growth, which is maybe another 6%, but that's still not 15%. If the option for me right now was to buy a 15% yielding bond, I would absolutely do that over whatever I'm doing over here any day of the week. Unfortunately, those yields are just not available today because the cost of borrowing money right now is far cheaper. So who are bonds for exactly then? Well, I'm a perfect candidate. It's actually something I wanted to do for myself for a while, and here's why. One of my short-term goals in the next 5 years is to buy a house and to save enough for a down payment. Well, instead of using my money to invest it into the stock market, which I might lose that money in the next 5 years, who knows, it might be worth way less, there goes the down payment. Or instead of parking it into a high-yield savings account, which might only give me 2%, I might want to put it into a short-term, high-yielding bond of 3+%. Let that money grow for the next 5 years, let's say, in interest. And then after the 5 years, I'll get back that $30,000 or $20,000, whatever I put in there, and then I'll use that to buy myself whatever it is I need. In this case, a house. But for you, maybe it's a car. Don't buy a car though. That's not an asset. That's definitely a liability. But it's something to consider because this way, it's a far more safe investment. Because I get that asked from time to time, like, Andrei, I have $20,000. I'd like to invest in the stock market, but I also would like to buy a house. What should I do? Should I invest? And the first thing I tell people is, don't ever listen to anything I say. But the second thing I'll say is, don't invest your money in the stock market if you know you're gonna need that money in the short term, because the last thing we want is to have that money just disappear in the next 5 years. And here's 2 methods how to calculate how much money you need invested in bonds. So you can take your age and subtract it from something like 110 or 120. So for me, for example, I'm 30 years old and I can subtract it from 120 to get 90. My math skills are impeccable, I thank you all. And 90% is how much I need to be in stocks, and the remainder of the 10% I need to be in bonds. Now you can do an even easier method that's even more conservative, where you take your age and that's literally the exact percentage that you need in bonds. So for me, that's 30% in bonds. This is conventional wisdom and conventional advice, but I think in today's economic conditions, this is pretty bad advice. The one thing that people don't talk about relating to bonds is the cost of opportunity. Wow, it's so hot. By the way, this video is sponsored by nobody. Webull just sent me this shirt for free. It's pretty, it's blue, it's free, and it's comfortable, so I'm wearing it. But if you want your free stock, click the link below this video, fund your account with $100, and you will get a free stock worth $8 to $1,000, and I will get paid, and I'll eat this month. It's amazing. Very random, but let's continue. The biggest risk to bonds is the cost of opportunity, because interest rates change very slowly. Bond prices don't really fluctuate much at all. So they're a great tool for preserving your wealth, but this is where you and I might disagree, because I think that in order to preserve your wealth, you need to have a wealth to preserve, and that number might be different for you and I. For me, it's something like at least $1 million or more. Then it's worth preserving. But if your number for retirement is $500,000 and you're happy with $20,000 a year at 3.5% to 4%, then that's perfectly fine if that's what you want to protect. But I think anything less than $1 million, you should absolutely aggressively invest into the stock market to give your money a chance to compound and grow over time, especially if your investing strategy is long-term. But I'll give you guys an example because I hate speaking in hypotheticals. My parents, very special case. In fact, my dad actually turned 53 just yesterday. So happy birthday to my dad. I know he's probably not watching this video, but I actually got him a PS Vita for his birthday. It's hacked. It has all the Nintendo emulators. Play Donkey Kong. It's amazing when you travel. Pro tip. So anyway, my parents, I actually put them 100% into stocks for their 401k because they started investing really late in life. And because of that, they don't have that much money in there, maybe $20,000 a piece, which is not a little, but it's not enough to be conservative with. And realistically, they have about 15 or 20 years of work ahead of them, and that gives them enough time to at least let that money compound over time. And if they had hundreds of thousands of dollars or $1 million or more, then I would absolutely give them bonds to help them smooth out the ride in retirement. But even then, I would probably still park their money into something like VYF, which is Vanguard's dividend exchange traded fund, and it's yielding around 3.3% right now. And that's just the dividend yield alone, not even counting the price appreciation of the ETF itself. And I think that would be a better use of money for them right now. Full disclosure, I own 0 in bonds at this moment because most of my money is in dividend growth stocks, and I've been tracking my income from 2014 onward. And from 2017 onward, I actually stopped contributing from my active job because I quit my job. I didn't have any income, so I would only contribute whatever my portfolio would generate. I would just reinvest it back into itself. And you guys can see from 2017 to 2018 and 2018 to 2019, every single month has been trending higher and higher to about the average of 6%, which is just incredible, not even counting the capital appreciation. But Andrei, if dividends are so great, then why is the bond market larger than the stock market? Surely trillions of dollars can't be wrong. If you were around during the last recession of '08, you would have wished that you had some bonds in your portfolio. And people really do overestimate their confidence in the time of recession of not losing their money by just selling everything. But every time this happens, people scream, this time it's gonna be different because it's this president, it's this bubble, it's this thing, everything is gonna go to zero, and people get scared. But it's precisely in that situation when you want to be invested in bonds to help you smooth out that ride in case you're skittish and you can't stomach seeing your net worth drop in half. That's a scary thing. And even though I've never been through one of these bad economic recessions, I do understand what needs to happen in theory, but putting it into practice is a whole nother story. But maybe you're not like me and your risk profile is not as high as mine because perhaps you're nearing retirement age and you're getting a little bit older and you want to protect what little you have left because you don't have enough to survive on passive income alone, so you'd have to withdraw based on the principal. Or maybe you're on the other side of the spectrum where you're really wealthy and you have like $3 million. Why risk it in the stock market? Just get yourself a bond that's yielding 3.5% and be making 105 grand a year for the rest of your life. Just make sure you're outpacing inflation and you're set. That's your number. Why bother risking it? Perhaps you're somebody like me who has a short-term goal to buy a house or a car or something large, and you want to invest your money not in a savings account, something a little bit more, but you also don't want to risk your principal investment. Bonds can be a great companion to do that for your short-term goals. Now, I hope I won't have to, but Andrei, me, if you're watching this in the future and the stock market has crashed, I want you to pull yourself together, don't be depressed, and continue investing in blue chip growing dividend stocks that are paying you every single month, and keep reinvesting it as you do. And if for some reason you forgot what it felt like to be worth a couple $100,000, I'll remind you, you're still gonna have imposter syndrome, you're not gonna be any happier. Just remember, money doesn't buy happiness, it only rents it. So, love you guys, each and every single one of you. I hope you enjoy, and a happy early Halloween, and I'll see you guys all on Friday. Bye-bye.